This LOS is describe short-term funding alternatives available to banks. Short-term funding alternatives available to banks. Banks, such as deposit-taking or depository institutions, typically have access to funds obtained from the retail market, that is, deposit accounts from their customers. However, it is quite common for banks to originate more loans than they have retail deposits. Thus, whenever the amount of retail deposits is insufficient to meet their financial needs, banks also need to raise funds from the wholesale market. Wholesale funds include central bank funds, interbank deposits, and certificates of deposit. In addition to filling the gaps between loans and deposits, banks raise wholesale funds to minimize their funding costs. So this LOS looks at some short-term funding alternatives available to banks. So the first is the retail deposits. One of the primary sources of funding for deposit-taking banks is their retail deposit base, which includes funds from both individual and commercial depositors. Then we move on to the short-term wholesale funds, and wholesale funds available for banks include reserve funds, interbank funds, and certificates of deposit. Reserve funds. Reserve funds act as a liquidity buffer, providing comfort to depositors and investors that the central bank can act as a lender of last resort. Interbank funds. The interbank market is the market of loans and deposits between banks. The term to maturity of an interbank loan or deposit ranges from overnight to 1 year. The rate on an interbank loan or deposit can be quoted relative to a reference rate, such as an interbank offered rate, or as a fixed interest rate. An interbank deposit is unsecured, so banks placing deposits with another bank need to have an interbank line of credit in place for that institution. So a quick practice question to check our understanding. Which of the following is a source of wholesale funds for banks? A, demand deposits, B, money market accounts, or C, negotiable certificates of deposit? C is correct. Wholesale funds available for banks include central bank funds, interbank funds, and negotiable certificates of deposit. A and B are incorrect because demand deposits, also known as checking accounts, and money market accounts are retail deposits and they're not wholesale funds. I just put this question in for fun because the first one, which was looking for the true, and this one's looking for the false, okay? So which of the following are not considered wholesale funds? A, interbank funds, B, central bank funds, or C, repurchase agreements? Okay, I think that one should be fairly easy if you're doing your memorizations. So C is correct. Wholesale funds refer to funds that financial institutions lend to and borrow from each other. They include the central bank funds, the interbank funds, and the certificates of deposit. So those are the three that you need to memorize. So although repurchase agreements are an important source of funding for the banks, they are not considered wholesale funds. So that's a pretty important practice question, a very good one. Short-term funding alternatives available to banks. So now we're moving on to large denomination negotiable certificates of deposit. A certificate of deposit, CD, is an instrument that represents a specified amount of funds on deposit for a specified maturity and interest rate. CDs are an important source of funds for financial institutions. A CD may take one of two forms, negotiable or non-negotiable. If the CD is non-negotiable, the deposit plus the interest are paid to the initial depositor at maturity. A withdrawal penalty is imposed if the depositor withdraws funds prior to the maturity date. There are two types of negotiable CDs, large denomination CDs and small denomination CDs. Thresholds between small and large denomination CDs vary among countries. For example, in the United States, large denomination CDs are usually issued in denominations of $1 million or more. Small denomination CDs are a retail-oriented product and they are of secondary importance as a funding alternative. Large denomination CDs, in contrast, are an important source of wholesale funds and are typically traded among institutional investors. So we'll just finish this LOS with two quick practice questions. The first one, a large denomination negotiable certificate of deposit, most likely A, is traded in the open market, B is purchased by retail investors, or C has a penalty for early withdrawal of funds? Okay, that should be a fairly easy question. A is correct. Large denomination negotiable certificates of deposit can be traded in the open market. So B is not correct because it's large denomination. It's not typically purchased by a retail investor, okay? And C is incorrect because it says a large denomination negotiable. It is negotiable, not non-negotiable. Remember, if the CD is non-negotiable, the deposit plus the interest are paid to the initial depositor at maturity, and a withdrawal penalty is imposed if the depositor withdraws funds prior to the maturity date. Okay, one last practice question. It should be very easy because it's very similar, but anyhow, we'll do it. A characteristic of negotiable certificates of deposit is A, they are mostly available in small denominations. B, they can be sold in the open market prior to maturity. Or C, a penalty is imposed if the depositor withdraws funds prior to maturity. Again, that should have been an easy one. B is correct. A negotiable certificate of deposit allows any depositor, initial or subsequent, to sell the CD in the open market prior to maturity. So A is incorrect because negotiable CDs are mostly available in large, not small denominations. Large denomination negotiable CDs are an important source of wholesale funds for banks, whereas small denomination CDs are not. And C is incorrect because a penalty is imposed if the depositor withdraws funds prior to maturity for non-negotiable CDs. And that's the last slide for this LOS. Thank you.